morning. Thanks, Michelle. My name is Matt Moore. Okay. With Verdance Capital Advisors. I want to thank you all for joining us this morning for our discussion. In a minute, I'm going to bring up our panelists. Our conversation today is going to be focused on some interesting topics around M&A activity during this COVID time period. I hope this webinar finds everybody well. We wish you good health and stay safe during this. I'm not going to say unprecedented time period, but we're seeing some very interesting things going on. So today we're going to be focusing on successful outcomes in M&A activity. We have some great panelists, and I wanted to go through a little bit of housekeeping on our webinar structure. During the talk, we welcome questions. There is a button at the bottom of the screen that you should be able to click on to submit a question. We'll be reviewing those real time as we go through our discussion, and we'll be happy to address those. And at the end of our panel discussion, we will take time to go through with an open Q&A and be happy to address those questions. Feel free to throw them in now or at the end as well. So let me get started with some introductions of who's joining us on our panel. We're very excited to have pulled together a group that not only are experts in their areas, but share a unique qualifier that all three panelists are founders and have grown successful teams and are working independently in this space. Our first guest I'll introduce is Greg Nossaman. Greg is a managing director with G Squared Capital Partners. There he is. Morning, Greg. We've done some work with Greg. We've had some interesting discussions, and he has a team that he's building that focuses in the defense, government services, aerospace, and is providing I would say a complete offering in the space. Greg, why don't you jump in and share a few things about G Squared that some of our attendees may not know?
Sure. Well, Matt, thanks for having us, and thanks to the Verdance team. We're very happy to be here. So I guess probably the most notable thing about G Squared to know right now is that we founded in April of 2020. And so naturally, being the market prognosticators that we are, we thought, what better time to found a new investment bank than at the onset of a world pandemic? But
what could happen?
That's right. What could go wrong? But although we are a new name, we are a very familiar team in the industry. I am the ultimate in one-trick ponies. I started off in the late 90s at a boutique investment bank called the Windsor Group, which is really the first investment bank focused on the government services market. Our team grew pretty well. We ultimately decided to sell ourselves in the mid-2000s when we had 30 bankers. We sold to BB&T Capital Markets, so it was great to be part of a larger platform and experience the benefits and some of the growing pains of being part of a larger organization. Bounced to a different investment bank called the McLean Group. And I should say, most importantly, the co-founder of G Squared, Greg Woodford, his original sin was that he made the mistake of hiring me in the 90s, and he can't shake me since. So all of these stops, Greg was alongside me. And then this year, we decided that we saw a market opportunity to found a new investment bank that, in our minds, brought together the best experiences that the best practices of an industry-leading investment bank to really the lower end of the middle market, which we think is a little bit underserved. And so what we did is we assembled what we think is a best-in-class team, and we are focused on transactions really between 30 and 250 million of revenue. A lot of our investment banking friends and peers at competing firms have gone on to great platforms. They're great investment bankers, but the platforms have pushed them up market, and they're not really able to provide the same level of full services to the market that we are focused on. And since we've been doing this for 20 years, we feel like we've got a pretty good grasp on the best way to manage and be professional and affect best outcomes for clients. We do focus, as you said, on the government market. About 75% of what we do is on the services side, be it IT or professional technical services, and the balance is either manufacturing or aerospace as it touches the defense market. And so we've got a team of 5 folks now, and we're growing quickly, and really excited to be here today.
So you can field a basketball team with 5. That's good.
That's right. We'll move on to baseball next.
You've got valuation, capital raise. You're working with boards of director, providing opinions as well. It's a pretty full advisory suite, it sounds like.
That's right. And look, we've gotten lucky in the folks that we've been able to recruit to our team. We've got folks that come out of accounting backgrounds, evaluation backgrounds, obviously from an investment banking background. And we're trying to bring together a comprehensive team that understands not just the transaction side of an M&A event, but really also the underlying factors, the strategy behind it, the detailed accounting nuances that we've all seen trip up transactions, try and get ahead of those. And so we're pretty excited. We are transaction focused, but as you mentioned, we do provide valuation advisory, valuation opinions, and also strategic advisory to companies, really primarily to companies that have an ultimate strategy that they're trying to execute on towards an eventual transaction where we think that it makes sense to have a long lead in terms of preparation time.
Well, congratulations on starting, and I'm sure you'll look back on it in 5 years and laugh at the timing of April, but
laughing for the right reasons, right?
That's great. And I'm going to move on and introduce Guy. Our next panelist, Guy Filippelli, is a founder, a successful entrepreneur, and has now founded Squadra Ventures, working with early stage growth companies. I've gotten to know Guy over the last couple of years. Thrilled to have you join our panel discussion this morning, Guy. And why don't you take a minute and talk specifically about Squadra and what you're doing right now. And I doubt I could fit all of your accomplishments into a 2-minute intro, so I'll let you take it away.
I can definitely fit it into 2 minutes.
Take 3.
First of all, pleasure to be here. My quick background: grew up in Cleveland and Detroit. Was a technical kid growing up. Dad brought me a computer when I was 11, and kind of never stopped punching keys since. Ended up at West Point thinking, though, that I would never do technology again and become an Army officer. As luck would have it, at 9/11 hit, and I was identified as a young guy who could be helpful in running software teams for, at the time, the head of the Army intelligence. And for the next 5 years, I ran software teams in the Army, focused on basically analyzing bad guy communications and stuff like that. And then my boss became the director of the NSA. So I came back to this area for the first time in 2005. And I got out of the Army and left NSA in 2006. And I started a government service company. What I knew how to do at that point was run software engineers hard and write proposals and deliver capability to government. And so we built a government service company. We bootstrapped it and it was called Barico Technologies. We ended up, it's a long story. The short of it is, in 2011, we sold a piece of it. We spun off another piece and sold it, and then kept it, and then finally sold it 6 years later to Novetta Carlyle. And then in the meantime, I launched a venture-backed startup called Red Owl here in Baltimore. So I moved to Baltimore. We raised a lot of money. We eventually sold it to ForcePoint in 2017. And then I had a strong thesis about how, the net of it is, I felt like the venture capital community was suboptimally poised in this region, especially, to help launch and eventually bring these early stage startups to successful outcomes. I was underwhelmed in hindsight by kind of what I got from my investors, I guess is a different way to say it. And so we dedicated ourselves to launching a new early stage venture fund last year. Squadra is, it's the Italian word for team. We always tell entrepreneurs there's 3 teams at the table. There's your team, there's our team, and there's a combined team. And our mission is to invest in companies that we call institutional seed, meaning they're raising $1 to $3 million. We're the lead investor. We're always on the board. We have a very basic mission, which corresponds with, this webinar in many ways. Set them up so that they can achieve a successful exit at one point in the future. Now, that's usually beyond us. It's usually 5-6 years out, but the first 18 months is critical. And so our moment is the first 18 months where we are there to get the company right, get the team right, get the strategy right, prove out all the initial value, and then bring them in the next big investor. And if we do our job right, we've made the eventual exit path that much more successful. I've got an 8-person team. And we're grinding. We made 5 investments last year, 1 in Baltimore, 3 in DC, Northern Virginia, and 1 up in Boston, and we're having a great time. So I am excited to be here today, specifically to talk about exits and preparing for exits, though. Because
Right.
I've had some, quote, great outcomes, and I've had some great screw ups. So I'm happy to talk about, what I've learned from that process.
Yeah, sometimes we learn best from those as well. But what I love about it is in your description with Squadra is, you guys bring more than just a check. So that talks to the team, your level of involvement and empathy with the founder and the CEO. So we'll get into that as well. Thanks for joining us this morning. Really looking forward to the discussion. Let me move on and bring my team's founder and CEO onto the call, onto the Zoom. Leo Kelly. Leo and I have known each other for a couple decades now. Thrilled to be working together. And he's the 3rd founder on this panel discussion. And Leo's led the team, started with an idea and has built what is now Verdance Capital. I'll let him describe a little bit more about what's going on. But it's great to have everybody on the call. Leo, share a few thoughts.
Sure. Thanks, Matt. Welcome everybody to the webinar. Always enjoy talking about the concept of exit. We thought what would be unique today is to have 3 founders who are in the world of exit in 3 very different categories. Essentially a buyer, a seller, and an advisor, and to give a very rounded perspective that the whole process. And yet, from our standpoint, so as Matt said, I'm CEO of Verdance. Started at Merrill Lynch, just to be very quick, started at Merrill Lynch, was there a long time, thought I'd retire, left in 2012, and started a business inside a bigger business. And then in 2017, we founded Verdance Capital Advisors. I love to talk about this topic because the core of our advisory business, we're a pure advisory business, and businesses and entrepreneurs, business exits and entrepreneurs are the vast majority of our business. And so this is what we talk to folks about every day, about some of the hard realities of the process of exit planning, and then what it's like to be on the other side of an exit and being really prepared, being psychologically prepared for that moment. So, so this is always fun for us. And at the same time, we are in the space. And some of the ideas we're going to talk about today, or at least I'm going to try to bring up today, is the concept of organic growth versus inorganic growth, the concept of acquisitions and then eventually selling. We are a buyer in the marketplace in our business. And ours, while every business has unique characteristics, there's obviously common traits to this process of buying and selling that really transcends all different types of businesses. So it should be a great conversation. I look forward to having it.
Yeah, it's going to be great. I appreciate you framing that as well. What we have, Michelle, if you can bring everybody back on for the panel, for our attendees, we've got a buyer, seller, advisor. Everybody here is talking about how to coordinate and get to that great outcome, which is unique and custom to each founder, CEO, owner. But the juxtaposition among that should lead to a very interesting discussion. And I'm going to start out with Greg with a question for you that kind of jumped out over our previous discussion, and then we'll take it from there. In this COVID time period, Are deals getting done?
That's probably the first question we get these days. And it's a complicated answer. So I know I sound like an attorney when I say it depends, but it does depend. And it depends primarily on the market segment, the size of transaction. What I will say is that in April, kind of when you look at it from a macro perspective, I think most deals sort of shut down in April, end of March, even through early May. The transactions that we saw really on a national basis that were getting done tended to be the transactions that were pretty far along before the shutdowns began. And so pretty far along are transactions that had purchase agreements that were negotiated going back and forth, where it was a matter of kind of closing things out. By and large, those did, from our perspective, get done. What we saw was a slowdown on companies that had either recently launched to market or companies that were thinking about launching to market. And so there was definitely a gap kind of nationally. We also saw private equity groups pull back initially pretty significantly, as did strategic buyers kind of across different markets. So then the more nuanced answer is, depending on the market segment, things have come back pretty strongly. So within our focus on the government and defense market, really starting in May, we started to see a resurgence of buyer interest. We started to see a pickup in, part of our job is to read the tea leaves so that we can give good advice to clients on when there's a critical mass of buyers. Last thing we wanted to do is launch a process when only 40% of the potential buyer pool was willing to look at transactions. And what we found is through our kind of daily interactions with various buyers throughout the community, is that starting in really mid-May, buyers started kind of coming up for air. They'd already made the big transition to telework for the majority of their workforce. They've taken care of their clients. They've learned how to operate constructively in the new domain. And they were starting to feel more business as usual, as normal as it could feel, at least. And as a result, M&A activity was starting to come back on the forefront. Initially, that was largely driven by buyers that either had large amounts of cash on their balance sheet or private equity backing where they could write a check and do a transaction. But subsequently, we've seen really all categories of buyers in the aerospace and defense and government services market kind of reemerge. And we would characterize the last 4 to 5 weeks as being frothy from a volume of transactions perspective. Certainly we have a number of things that are out in the market, but we also know, a number of businesses are now in the market. And it's continued to evolve at pretty rapid pace. The second question that we get as part of that is, okay, well, what are valuations?
Don't take my questions ahead of time.
It's a natural follow-on. And what we've seen is that for the most part, valuations are holding pretty strongly. In our segment of the market, prior to COVID, we were arguably at a 10-year peak, maybe an all-time peak in terms of the valuation multiples that businesses were garnering and earning. And the good news is that they're still holding relatively firm. Companies that are well-positioned really handled the transition pretty seamlessly into the COVID work environment. The government, fortunately, is still issuing task orders, new contracts. In some cases, they've been delayed a little bit, so you're seeing more contract extensions. But by and large, it's been businesses as usual. From a macro perspective, you look at the other segments of the economy that are a little bit more challenged. And the government market looks really attractive. So you're seeing folks double down on the government market. You're seeing new entrants come into the market, folks that were toying with the idea of investing in the sector that are now pretty committed to it. And so that's all positive from that perspective as well. Where valuations may struggle a little bit are companies that have certain challenges that may have made them difficult to sell pre-COVID, may be more constrained in this environment. That's the theory, although the anecdotal truth is that we're not really seeing a lot of negative impact to those companies either.
So I'm going to take that as a yes, the environment is good, and that the discussion on multiples, I'm going to ask Guy and Leo to talk to, but that's always the loaded question, right? That's sure. The crazy part of everybody that's looking to, assuming you have a transferable business, everybody wants to know what their multiple is, what their number is going to be. And this speaks to surrounding everybody with the right team. Assuming we have a business that's growing, moving forward, I'm going to start with Guy and then throw it back to Leo on how do you approach and set an owner, a founder on the course to a successful outcome, which may not be a sale, It could be an investment, it could be growth, but how do you work with them on setting proper expectations and looking around on their advisory team and making sure they have the right people in place?
Yeah. So a few things. Number one, I think it's important to figure out what kind of exit are you going to be. In some cases, it's a very different thing if you are of the pattern where someone is buying you to incorporate you to be a part of their thing, and they're going to value you on what you are right now. And I think a lot of times when you're buying services businesses, that's the case, right? Like, hey, we're going to incorporate this chunk of revenue and EBITDA into us, and therefore, it's going to increase it's a fairly linear kind of a transfer of equity, really. It's very different when it's more of a, hey, we're going to buy this piece of technology that's never been sold before and we've never applied a global sales force to it. And we're suddenly now going to apply our global sales force to this thing that only previously had a 4-person go-to-market team. What can we do with it? At least in the world of software and enterprise technology where I play now, that's the pattern, obviously. And so the key takeaway there that I had to learn by having that beat into my head is that you go in and you say, well, I'm a software business, so I must be 10x multiple on my revenue. But it's such the wrong way to think about it in hindsight. What you are is you are a piece of technology that you've proven can be taken to market with a certain set of economics, and you're a potential value stream of X $100 million for this global business with this amount of resources into it. You're an investment for this business. And so if you can think to yourself and frame the entire M&A process around the fact of, look, I know we just did 12 million in revenue last year, but we also know within 4 years in your enterprise, this is going to be $100 million a year revenue business that's going to add $600 million to your share price based on the way your economics are set up. Here's the cut of that we want, and here's our commitment to make that a reality over the next 3 years. To me, those are the kinds of scenarios and patterns where you can really maximize value. And the implication on the sales process at that point, though, is it'll actually change the way I think that most people even talk about their company in the initial meetings, the way the materials get put together, the way the targets of the M&A process get set up. So obviously Greg and his team are critical players in that. But you as the entrepreneur have to be the true champion of that. It's got to come out of your veins that's what you want to do. I used to say, I think this is when we were selling Red Owl and we ended up selling a ForcePoint. Early on, even in a dinner with the CEO, I said, look, I don't want an exit path here. I want more responsibility. And that was exciting to them. I want to take my $10 million business and I want to put it into your, and I want to be you, and I want to take it global. That was what they were buying, right? So just very different patterns. I'll stop there and get Leo's take on that.
Sure. I mean, I think you hit on some really critical points. I'd say what we're seeing is a reasonably bifurcated market where reoccurring revenue stream businesses, that market has continued to stay very active. Ours business being one of those. Activity really didn't slow down. Interestingly, the valuations didn't come down at all. But I will say that this whole event is going to change the marketplace. So for more cyclical businesses who we invest in privately, we have seen a disruption in the marketplace. So what I would say is, here's what has changed. A couple things. Terms are changing. Where multiples aren't, terms are changing. Before the coronavirus, what we were seeing, at least in our business and in a couple others where we're active, we were seeing these baby boomers. Remember, there was an enormous there's an enormous baby boomer population that owns businesses who are getting mature. And our generation, Generation X, there's not as many of us. And there's not as many entrepreneurs coming up who want to take the risks involved. And baby boomers are selling to the market. It's why the private equity market is so active. And so when I could say in our business, when the virus hit, there was a lot of lifestyle owners who have been living a cash flow lifestyle, who suddenly saw the first major piece of stress in over a decade. And they said, okay, I'm ready to sell. And prior to this event, we were seeing deals done, very large cash amounts, not a lot of back end, and people were just selling and taking a pretty significant bid. Post this event, the deals are different. There's less upfront, there's more back end triggers. It's one way that folks who feel like, well, my business has been impacted by coronavirus, my earnings are down, I don't want to sell right now. So as a buyer, the only way you're really going to be successful there is you have to give them an avenue in which to grow back the business and maybe get a second bite at the apple. So we're seeing the deal structure look a little bit differently. We are also seeing, as I said, more activity where folks are looking. Now I know in our business they're saying, okay, this was fun for a while, but I'm a little nervous now. And what I would say, if you're a seller and if you're a buyer, what you should be looking for, and Guy alluded to this. I'm just gonna hit the point one more time. We tell clients that we advise. So we advise folks through these processes, and then afterwards, we tell folks, especially owners, be honest with who you are. Hyperbole is the enemy when you're going through this process. If you are a business owner who is running a business for a lifestyle, there is nothing wrong with that. But don't go into the process saying I'm a growth owner. If you're a lifestyle owner, you're a lifestyle owner. If you want to sell the business and you want to exit and go on to your next life, but you feel like you should tell the ownership that I'm going to be involved and I'm going to stay active, they will see it, they will read it, and that tension will show up in their interest. It's just really important for you to understand exactly who you are as a seller so that a buyer knows who you are. And we have been through this process. We have seen folks come and say, we're growers, we're organic growers, we're excited, we want more resources, we want to get involved with a growth company, and at the last minute pivot and take the highest bid of an organization with less resources. So I would say now more than ever, as you go into the process, it's good to sit down with somebody who's been through this. It's good to truly evaluate who you are as a seller so that they know who you are as a buyer, and then go into it eyes wide open on both sides, and you're going to have a more satisfactory outcome. And, it just goes beyond, obviously the first thing we hear from everybody is, what's the turn, right? How many times pick a target, EBITDA or book, or depending on what the business is. And the answer is, what's really most important is not getting the highest necessary turn. It's getting the right partner, and the right partner depends on who you are as a seller. If you're selling and walking away, then getting a big turn and more cash sounds great. If you're a growth machine and you're just looking to expand your resources, which, by the way, the coronavirus has exposed companies who lack resources to grow to accomplish their goals. And it's gonna force one of two outcomes. You as a business owner are either going to have to invest heavily to fill the gaps in that have been discovered through this, or you're going to have to find a partner, again, via acquisition or merger or whatever the case is, who can fill those gaps in for you and create a 1 + 1 = 4 or 5 result. And now's the time to evaluate honestly and go after that, find that partner. And obviously, it goes so far beyond multiple. And that's why, people like Greg, people like, excuse me one second. Excuse me, people like Greg and people like Guy are so important in the process, right? as they're good partners.
Let's pick up on that, on the honesty and transparency of messaging and being honest with yourself as the owner. And I'm going to throw it over to Guy and Greg. We've got Guy as a source of capital that's coming in to help an organization grow by purchasing a part of that and scaling it and providing them the resources. Greg is on the other side, helping, advising these CEOs, founders on how to selectively choose the right capital partner at times. And each of you take a turn and speak to, how do you message that to your existing team? How do you help that founder, CEO message that, where what Leo just mentioned, we're being brutally honest with everybody that we need to grow. It's hard to ask for help. I never ask for directions, so I know that it's hard to ask for help. How do you message that? And then I'm going to follow that up with, in normal times, how do you message it? But how do you message it now when your team might be scattered and everybody working from home? Guy, you can go first.
Sure. So I want to make sure I understand the question properly, but how do I message to people we've invested in? How important?
How do you work with that CEO? And you've had experience with this. You've just said it. How do you work with them to say, how do we work the messaging with that team so that they stay and feel a part of it to move forward for a successful growth path?
I mean, look, like in part of it, there's even a psychological component for me of having to make the transition from player to coach, is really hard. I'm not the player, and that's been probably the hardest part for me of this, even the transition I'm in. But one of the things that we've tried to do as a venture fund, now again, it's a little different. The venture world, I have the advantage that everybody knows it's all about the exit, right? So I don't have to affect mindset as much. I'm not dealing with lifestyle businesses, for example, right? But what I'm absolutely have to do in many ways is change where perception of value lies. And so to me, the most fundamental thing that we try to do right now is we actually try to get on paper a plan, always keep people looking out 18, 24, 36 months of where we think the business needs to be, and really be clear about what the value drivers of the business are. And then ensure every board meeting, and we're having 4 or 5 board meetings a year on average, we're measuring the right things that correspond to that value. I mean, that sounds very basic. That taught everybody in this call absolutely nothing, but it doesn't happen usually. And so the notion of what do we celebrate? I talk about this all the time. I'll give you one example. Let's say we have a company in our portfolio. We know they're an enterprise SaaS company. They're valued on recurring revenue, consistent recurring revenue that can be projected. When we sell one customer, it's obviously going to be projected across the next 10. That's very important. We're doing $2 million in revenue. Let's just make an assumption. All of a sudden, we get a brand new, $1 million contract, if you will, that's goofy and doesn't correspond to that model. The team's super excited because we just increased our revenue by 50%, but it's not the right kind of revenue. We as a board have to say that. And so it's teaching them what to celebrate. The flip side of that is next week we got a small contract that was much smaller, but it validated the pricing model. We celebrate that, where they might have thought, well, that's not that big of a deal. It's just a very early, no, that's a huge deal. So what I'm trying to do all the time is get in their heads and again, it's very simple. Teach them what to celebrate, reinforce that. I always feel like smart people will get there if they know where to go. The good news for us now, I'm not the M&A guy coming in and somebody saying, hey, all right, we're selling this company in 6 months, help me get there. You know, I have the liberty of, I have the benefit of often being able to be a voice years in advance, but I have to take advantage of that. And I also know that their window with me is probably only 12 months anyway before they, that's what I'm big on mindset. And because I always feel like smart people will get there if they know where they need to go. So that's my kind of approach.
Yeah, that's good. Greg, you are the M&A guy, so pick it up from there.
Sure. So first of all, Guy does the hard work, right? He helps to build and set things up so that guys like me then can help polish and message. But so everything that he talked about is so critical to being successful when we ultimately come in. So how does a CEO message to the team that there's going to be a transaction or a capital infusion is a really delicate question, and it has to be handled very sensitively. And there's not a one size fits all response. For the most part, the businesses that we deal with are people businesses, right? We used to say that the assets walk out the door every night. Now I guess we have to change it. The assets log off every night. And so it's really important that you take care of the people. And our experience is that it's a leadership thing. So if you get the buy-in and you get the enthusiasm and excitement of the senior folks, the senior management team, they are then able to help get the rest of the population of employees kind of online, right? If they see that their supervisor is enthusiastic and staying on, and the supervisor sees that their VP is enthusiastic and staying on, et cetera, it really helps to create a sense of excitement. And so look, there's a right timing and a right way to bring in the team. The key issue through all of it is to understand that anytime an employee or a leader hears that there's a potential change on the horizon, it's not human nature to gravitate towards the me issues. What does it mean for me, right? What does it mean for my job? What does it mean for my role? Am I going to have stability? I think a lot of folks who haven't been through this process before feel that an outside investor is coming in or a strategic acquirer is coming in. Oh, they're going to cut all the non-billable people. That's absolutely not the case in our industry, right? There are very few cases where that happens. And when it does, it tends to be isolated where there are a small amount of duplication. And so your team is an important selling aspect of this transaction for most buyers and for nearly every investor. And so you have to do it really carefully. So that brings in the question, okay, who do you bring in? Okay, you don't want to bring in everybody because that creates panic and a lot of uncertainty unnecessarily. What you want to do is, to some extent, Leo, it harkens back to what you said, which is you have to know what you want. And that will determine who you bring in. If you know that you want to, the day after the transaction, sell your house, pack up your office, and you're moving to the Bahamas, there's an argument that you should be bringing in a much earlier in the process, the next level of senior management that will be the continuity stream for the buyer or for the investor, right? And so you might want to bring in your COO, your VP of operations, certain key VPs that own customer relationships, your CFO. It wouldn't be uncommon to have 5 to 8 folks involved in the process earlier. If, on the other hand, you are gung-ho, you're looking for capital to grow your business, then it's maybe a potentially smaller universe of folks that you're bringing in. And again, it depends on the second aspect. I just stuttered because I'm so excited about it. The second aspect is when you bring them in. And sometimes you start off with a smaller group of people and then you enlarge it as the process goes on. And we think of it as the Goldilocks situation. You don't want to bring in people too early. You don't want to bring them in too late. You want to bring them in at just the right time. And so oftentimes when you think about the rigors of the process, initially when you're preparing to go to market, there's a lot of work. We ask a ton of questions. The accountants will ask questions, the lawyer questions, and you need to make sure that the right people are involved from your organization to address those questions. That could be a CFO and the owner, for example. It could be 7 people. If it's a large company, it might be 12 people. And we work with our clients on a case-by-case basis to determine that. As you go through the process, when you get to a management briefing phase and you're starting to then interact with buyers, you want to make sure that you're showing the face of the company correctly and whoever that might be. And then in the back end of the diligence process, there's going to be a lot of grinding out of questions. And so you might need to expand the pool then. So the message to each of those groups is slightly different, but it leads with you're important. There's a way to bring them in. Oftentimes there's an agreement where they have to keep the transaction confidential. They can't disclose it. And in return for their support of the transaction and as a reward for their efforts to date, there might be a transaction bonus that's paid when a transaction closes. Buyers often like to see that split into two components, one at close and then one some period of time after close to serve as a retention tool. And the way it's messaged, tends to be depending on the transaction you're looking for. If it's to find an investor, it's a great story. We found an investor that's going to help accelerate our business, grow opportunities for our employees, our managers, or clients. If it's a strategic acquirer, I think it's a similar message, just a variant on it, because the strategic acquirer, that to Guy's earlier point, is able to look downrange and see the real synergistic growth opportunities. They're going to have a role and they're going to buying your business because it's an expansion opportunity. It's a growth play. And that should be an exciting message for your employees and managers as well. So it's a long answer. It's a complicated question. It has to be done right because of the importance of taking care of the people. But it's something that we help to think through, with advisors like you, and I'm sure Guy does on a daily basis.
But one of the themes I'm picking up on, it's all about team, right? And guys, your group is named after the team. And I'm gonna start with Leo and go around the horn on a question based on having an advisory approach, not a transactional approach, but an advisory approach, and coordinating the team around the owner, the founder, and it could be one or two on that. Speak to how important that mindset is in keeping everybody focused on a successful, and how that's been defined, a successful outcome for that individual. I'll let my partner Leo start with that.
Speak to keeping the owner's team focused.
How important is to have the right member of the right team around that owner, maybe who should be on that team, advising them through this process.
Advisory team, yeah. Absolutely, and that goes back to some of what we were just talking about, is the know who you are. It's interesting. When we have initial conversations with business owners who start the process mentally about selling, I know who you are in about 20 minutes of the conversation, maybe even before you do, because this is, and we, one of our biggest jobs here is to prepare you psychologically for what's about to happen. And so I'll just give you a couple of examples of what I'm talking about. One thing is for certain, most entrepreneurs who are ready to sell, they've been grinding for a long time. They've been putting in the hours. This is their baby. They've been running 1,000 miles an hour. So this concept that you're going to be able to do this and then suddenly go play golf every day, it really is probably going to be a difficult transition for you. So what we're trying to advise with and help you understand is who you are. If you walk in to our office and talk about an exit, and your entire conversation is about the deal, and then what you're going to do with the money afterwards, that's one person. If all you're talking about is your second bite at the apple and how big you can make it, you're a different type of entrepreneur, right? There's these, and those are the extremes. There's these clues along the way. So what I would say is, to Matt's point, is you're looking for a team that can help you discover what the optimal outcome is for you, to be honest with you about who you are, be honest about the process you're about to face, and prepare you for that. And that comes, you need a wide swath. I mean, this is, again, to Guy made the comment earlier, I'm about to tell you something that teaches you nothing, and yet nobody executes on it. And that is preparing early, getting the team in place early. And the team includes your partners, like a guy who has guided you along the way to help you understand who you are. It's your partners that are in the business. It's bringing in good M&A advice to start long before you create a deal book, long before you try to adjust your EBITDA higher in the process to get a bigger number. It's preparing you to put yourself in the ideal situation so that when the moment hits, you do get the maximum output. It's finding an advisor because you're about to go through a major transition from a cash flow based life to an asset based life. There's going to be a big pile of money, and that's all you got for the rest of your life if you sell the business. How do you prepare mentally and financially for that outcome? It's getting an estate planning attorney, okay? Getting one turn higher and totally blowing the tax game doesn't help you. It's all about the highest net outcome. Do you have a financial advisory team and an accounting team and a legal team to help you through that process and work with the M&A team and your partners have that maximum outcome? It's critically important. Do it early. Do it early. And what I would also caution, and this is also important, when you started the business, you have legal counsel that fits your needs, you have accounting that fits your needs, maybe you have a financial advisor that fits your needs, but you pour everything into the business. And if suddenly one day you're fortunate to sell a business for 50 million or 100 million or 10 million or 500 million, you've made friends with your team, but you have to be honest again with yourself and get a team that fits the outcome that you're about to engage in. People who do it every day. People who any question you ask is not a surprise. People who are going to ask you the question before it gets out of your mouth. That's the team you need. So my advice is put the right team together. Make sure that they work together and that they respect each other and that they work in a very fluid manner for you.
Guy, any thoughts?
Yeah, I would add one thing. I mean, it's a little separate from the question. I think we didn't talk about today, which also super interesting, is when you run the process, make sure it always stays competitive. We didn't talk about. Do not allow yourself to be, and really that's where you got to lean on the Gregs of the world and trust them, right? When you're, if you can, you need to be able to walk away from the deal, and your advisors need to keep you grounded there too, so that you're mentally not checked into it too early, right? I mean, that's a balance we didn't really get into today. We didn't have time to, but I always said, like, I learned I wish I would have kept a couple of the times the process more competitive throughout and made every team feel like if things didn't go perfect, we were walking. I don't think we struck that balance all the time the right way.
Well, and Guy, to your point, the enemy sometimes of these deals, Greg will confirm this, is rationalization, right? You hit something that looks good, and suddenly you may even know in the back of your mind, I need to do more. I need to find a more competitive process. I need to keep fighting this fight. But you rationalize it away because it just sounds like it's something that you want. And as I said, and I'll say it again, your team helps you determine what the best outcome is. Simply, if you're going to sell a business for $50 million valuation today and you're getting 50% up front, and one bid is at 50 and the other's at 45, okay, but you're a grower, what really matters is the second bite at the apple. Because if the second bite at the apple is 4 or 5 times greater than one versus the other, competitiveness is more than a price. Rationalization comes with price. To Guy's point, competitiveness is also, well, does this company give me the ability to grow exponentially, right? And have my second bite at the apple be massive relative to the first. I'll get my liquidity that I need, but then I'm going to build wealth. So, Guy, I think your point is spot on.
Yeah, if I can jump in, Matt, on that point. Look, we spend a lot of our time strategizing on process, right? Process is really important in terms of how you ensure not just maximum value. Maximum value is critical, but also optimal terms and conditions, right? If you have equal price between 2 buyers, how do you pick? Well, one is who has the better terms. The other is, the second is who's the highest certainty to close the deal, right? And then the third one is what's the best social and cultural fit for me, for my employees, my business. And all three of those are important points that have to be taken in kind of consideration. And so our job is to help structure a process where if there's one bidder or if there are 30 bidders, it feels competitive to the one or the 30 bidders. We have strict timelines that people have to adhere to. The knowledge that a process is running, is being managed in a professional manner has a lot of ability to get folks to move in a way that they might not otherwise. Another aspect is on the certainty to close. Competition is really important on that element because we're asking buyers to do a lot of work before we ever down select to the ultimate acquirer. And doing work means they're expending resources. Sometimes it's internal time. Oftentimes it's engaging accountants and lawyers and other advisors to do work on their behalf. And that's a serious commitment. And so the process helps enable us to do that so that we maximize price, terms, conditions, certainty to close, and the cultural fit. It sounds very self-serving, but that's truly the value add that a well-run process will bring to a seller.
And your point, Guy, as a buyer, right, sometimes we're a little frustrating to bankers because we're fanatic about culture. We only want to buy cultural fits because our view as a buyer is we're organic growers. We grow organically very well. We look at every acquisition as an inorganic hub to grow organically around. So that person who's quote unquote the seller to us, that's what we're looking for, and that's what we're hoping they present to us. And as a buyer, we have to be competitive. We have to have our capital sources ready to go. We have to present ourselves as a strong buyer. There's no question. That's important.
It's great info. For our attendees, we've got about 10 minutes left. I want to be respectful of the calendar. I want to thank you again for joining us on our discussion. At the bottom of the screen, I'm sure we're all very fluent now with Zoom and Teams and whatever, but you can click on the Q&A and submit a question, and I encourage you to do that. We've had a couple come in already. So take a look at the time, and I encourage you to submit your question now. One question that jumped up to me and for our attendees, and I'll start with Guy and just kind of work our way again around the horn to Leo. What would you tell an owner right now, what to do right now, given what Greg has described of the state of the M&A? We've talked about culture, we've talked about messaging, whatever, just a top one or two of something to do to take action today. What would you recommend?
Get your finances absolutely rock solid right, and know who, pick your banker and know who your top 10 targets are.
Good advice. Greg?
So I think the best advice we can give is take the time to see the business certainly through your eyes, but also through the perspective of an outside observer, in particular an acquirer. I think this dovetails a little bit with Guy's comment, but the most successful processes that we're a part of are the ones where we know at the first meeting with the client what the first two sentences of the press release from the buyer is going to look like, right? Wow. Buyer X has acquired company Y, a leading provider of this in these markets. The company is, or the buyer is excited for this because of these reasons. If we can identify that early on and we know that that's the perspective, that really helps to streamline the process. And look, not every company is able to do that. Our job is to help companies to get in position to do that. And sometimes that takes a month, sometimes it takes 3 years. But being able to see how an acquirer would view your business strategically, capabilities, customers, contracts, where the risks are. A lot of the risks that a business owner, founder perceives in their business are slightly different than the risks that an acquirer will see in the business. Understand what that difference is. Understand how that impacts value. Understand what things are in your control now to start tweaking it in the short term, the midterm, and the long term, and start taking action. Engage with advisors, be it accountants or attorneys or investment bankers. Get free advice while you can to understand how they view your business, so that you can start to get a more holistic sense. The good news is part of the thing I love about our job is we work with such amazingly successful people. They've all taken big risks. They've all been successful. Most of them have found very different ways to get there. But at the same time, there's a constant learning that needs to go on. And this process and the sales process and how to value your company is another learning process that's different than the type of learning processes that most founders have gone through to build successful organizations. And so it's important to take the time to start doing that, whether you plan on selling next month or in 2030, because ultimately it will certainly have positive returns on the outcome.
That's great input. Like that. Envision the press release now. Leo.
I would say a couple things. One is connect with the people most important to you, your spouse, your partner, your mentor, or in the business, whomever it is, and really spend the time to understand what it is you're trying to get out of this process. Okay, what life looks like on the other side. Either I'm going to go run, as Guy said in his first, a bigger business, or our lives are going to change. Spend the time, understand that it makes you a better seller when you know exactly who you are and what you're trying to accomplish. It's remarkably important. And then I would say, get your team together early. I mean, our best outcomes, where clients are most satisfied with the outcome, have nothing to do with the price or the multiple. All of our best outcomes are when people have come to us early. They planned early, they've done the work early, they've estate planned early, they've lifestyle planned early. There's something I always say to buyers, that if this is done right, the day of the close should be one of the greatest in your life. The reality is what we see in most sellers, it's one of the most stressful in your life. Because you get there and you say, now what? What do I do? Who do I talk to? How do I fix this? What can I do anything with my taxes now that it's over? Right? And then you go home and you look at your spouse and you're like, oh, wow, we're going to be spending a lot of time together. All those things, if you prepare early, make it a much better result.
Yeah, I like that.
Ahead, by the way.
The famous quote to the spouse after the selling the business, it's for better or for worse, but not for lunch. So get out of here. Two questions just came in. If I can throw that around and see who wants to jump in, you can just raise your hand. This is election oriented, which is interesting. One of our attendees has asked about the prediction for the tech space post-election. I imagine they mean maybe valuation oriented or growth oriented or capital seeking that space.
Sure, I'll launch.
Okay.
That's what Guy and Leo probably have insightful things to add to it. But from our perspective, our presidential election year always creates uncertainty, and the market reacts to uncertainty, right? So in the last election cycle, we saw a slowdown of M&A transactions in the 3 months kind of running up to the November election, and then several months after that when things were a little bit delayed. That's a pretty consistent theme as it relates to at least the technology side of the government market, because although the budgets aren't going to change 50% one way or the other, traditionally, I think maybe early days of the Trump administration were an exception to the rule. But they might swing 5-10% one way or the other, but the way it swings is really important. Are you going to be focused on border security, or are you going to be focused on IT modernization, right? And that will impact strategies. What we've seen in the COVID environment is that COVID has so far overshadowed the outcome of an election that we're seeing a lot less of an impact of election concern this go around. And in part, it's because of the dynamics. If the Trump administration remains in office, I think everybody's got a pretty good sense for the direction that that's going in. If Biden is elected, then I think there's a pretty good consensus of the way things are likely to look. And so in some cases, buyers are placing bets on one or the other right now. But in most cases, buyers are looking for those areas that they think are going to do well regardless. And there are frankly a lot of overlaps of those areas. And so, that's from a strategy and an M&A perspective. If you're in the right segments of the market doing well, I think the election is going to be a pretty non-issue. You know, I think that Leo, you might have some thoughts on the tax impacts, which could be impacted, you know, based on the election, both from how companies operate as well as a capital gains event when companies sell. And so, turn it over to you guys.
Yeah, I you know, to answer your point, Greg. Two things with the election, right? First of all, it's way too early to know what's going to happen. So much happens so quickly in election years that trying to predict this is, you know, it's tough. What I would always say is the lead up to the presidential election in terms of what people think is going to occur tends to be far in excess of actual outcomes. Even when there's a new party in place, and even if they have Congress, which, by the way, go back in time, this is a cycle. It goes from one side to the other, and to the middle, and then the other, and to the middle. It's a fairly consistent cycle politically. What tends to happen when a new regime comes in, either Democratic or Republican, and they get the whole House and Senate, they tend to be able to get one big thing through. It's hard to legislate. It's hard. It takes a lot to get big legislation through. And so they may get one big thing through, they may get a couple small ones, and they'll do some regulatory changes. But when you hear 5, 6, 7 big things, there just doesn't, the country usually doesn't have that much appetite for a change on either side. So the buildup seems to be more dramatic frequently than what the reality is. And that's why we try to stay a little less emotional over these changes. In terms of taxes, you know, Trump saying he wants to keep them. Biden wants to raise them. Biden doesn't want to raise them as high as they were 4 years ago, but higher than where they are today. Again, you know, will it have an impact? Sure. Is there planning you should do? Yes. But you shouldn't let the tax tail wag the dog because the reality is we're just, the market will adapt. It'll adapt to the new rules and we'll continue to grow. That's what we do. Witness the growing recovery of the virus.
Guy, you're in the enviable position of the last word, and then we're going to wrap up. Any thoughts? Has it affected your thesis for your investment for your fund as far as the election?
Yeah, I think the COVID comment is much more relevant. I'll say that. One thing I would add is I think there's lots of balancing on both sides for the tech sector in particular. So where, yes, the taxes and all this are important, in reality, I think there's also strong arguments on the other side that some of the Trump administration moves on restricting H-1B immigration, and there's a lot of things that Trump's probably doing that are not great for the tech sector that Biden would do differently. So my point is net, there's a lot of activity on both sides, and I don't see anything violently clear on one side or the other. And then the final point I would make, just like people, when you're talking about investing, I think, I forget who said it, but somebody said, at the end of the day, tax incentives don't really cause you to, a tax incentive doesn't justify a bad investment, and a tax increase doesn't eliminate a great investment. You know, like the mindset is, if it's a great investment, you do it, and you just deal with what the taxes are. That's always been my mindset. That I think that's still the mindset of most buyers. I think it's the mindset it should be the mindset of most sellers, you know, and just maximize around it. So that's my last word.
No, that's great stuff. That's great stuff. And I would agree. And I can see Leo nodding his head to that as well. Good investment can be expensive, could be taxed. Who cares? It's a great investment. It's a great investment. Thank you all for joining our webinar today for all of our attendees. And I want to specifically thank Greg and Guy and Leo. And I want to encourage the webinar attendees to go to the specific resources, not only verdance.com, where we're going to have this loaded and have other resources available. We encourage you to go there. Guy's team at Squadra can be accessed at squadra.vc, and Greg's team is at gsquaredcap.com. Please take some time and reach out if they have any specific questions. From time to time, we try to assemble some world-class talent And I think today we've been rewarded with that. So Guy and Greg and Leo, thank you for making this some very useful time for everyone.
Thanks,
Thank
everybody.
you.
Right.
All right.
Thanks, everybody.
Thanks for joining us. And I'll let Michelle end the meeting. She has the button to turn it off.
All right, thanks everybody. Take care.